Hey, Mike Swanson here. If you read my monthly newsletter Sunday morning, you'll know that I was planning on taking some investment positions today, and that's exactly what I've done. And I'm going to go over them real quick in a presentation. But the first thing I did, though, is I closed out that SDS position I bought last week, which is designed to bet against the stock market. I closed that out for like a 3% loss overall. So that kind of sucked, but that's okay. Those things happen. And when I bought that, I was intending that to be like a short-term trade that I'd hold for a couple weeks. Now, these positions, though, that I bought right here, I'm planning on just holding these things for probably a couple years, 2, 3, 4 years, maybe even longer. We'll just, who knows? But they mostly are dividend-paying positions or exchange-traded funds. And let me go over this and show you what I'm talking about here. So why, got to read the monthly newsletter to really get the details on this, but my views on the market have changed. I was thinking until this weekend, really, and I looked over everything Saturday and really analyzed stuff. But I was thinking that we were going to see a big correction in August and September that would lead to a great buying opportunity, and I was planning on just waiting and buying. But I think with what's happened last week in the stock market, there's a 75% chance that that's not going to happen. And instead, markets are going to rally next 6-8 weeks and then have a pullback and then go into new bull markets. Now, I'm not talking about the S&P 500 here. I'm talking about markets all over the world, European markets, Asian markets, and so forth. And this ETF is EEM. I didn't buy that, but it's a composite of a bunch of emerging markets together. So it's useful to look at this to see what's going on in the rest of the world. And when I look at the rest of the world and not the United States, what I see is they've been in bear markets now for quite some time. Almost every market in the world at least a year, some for 2 or 3 years. And we had a big correction in them in May and June. They fell 10% just in a matter of days, which is a massive, massive correction. And they've stabilized since then. And, if they continue to rally, which I think they will because we're seeing some of them break out the past couple of days, then they probably will peak out at resistance, which is basically the spring-summer highs, pull back, and then go up again. Now, if they do that, this is just a projection. They may not. I'm not saying that EM is going to fall exactly here or whatever. It's just kind of a way to think about it, that trend is up, sideways down, and then new bull market starting at the end of the year or early next year. And if it plays out like this, what you'll see is a reverse head and shoulders pattern formed over a year, basically. And we saw something similar to that happen in the U.S. stock market in 2002 to 2003, and also in lots of global markets too, from the fall of 2008 bottom to the spring of 2009. So I think that's what's happening. I think the world markets are in a transition from bear to bull, and the U.S. stock market never went into a bear market. We'll talk about that later. But I really think the opportunities now for the next 2 or 3 years are in other markets for the big gains. And right now, I'm buying high dividend stocks, planning to hold for 2 to 3 years, maybe even longer. And I'm thinking this is going to be a core position that I'm going to build around. And my goal is to average in from now until the end of the year in a good position that I can hold for what I think will be big cyclical bull markets in other markets all over the world, including gold and commodities. So I'm looking to be fully invested by the end of the year, but I'm averaging in now. I'm not trying to be perfect, By buying 20, 30%, I can hold if I'm wrong or if the markets here just all of a sudden start dropping tomorrow and fall 20% or 30%. That would give me a 6% loss of my account or whatnot, and I can weather that. So what I'm looking to do is add more money to my portfolio account over the next couple months and then deploy that money too, so I'm fully invested. And I'm going to be watching, though, every week because there are some things I don't want to miss out on that could break out that are forming good bases, and like the SEA Exchange Traded Fund, which is shipping stocks, gold stocks in some cases. So, in other words, I'm expecting a rally and then a correction that I'm going to be adding on to. So let's look at what I bought. TNK, this is a shipping stock that pays a 15% dividend. It's basing here in a stage 1 base, and it should be going into a new bull market by the end of the year. So the thing is, I don't really think there's much downside in this stock. Let's say it falls down here. Well, I'm getting the dividend. Over a year, I'm going to make 15% of it. Doesn't go anywhere. So I'm not too worried about that. And this stock could easily start moving up, and I'm getting the dividend and the capital appreciation. VIP, which is a Russian telecommunications company. It's got operations all over Eastern Europe and all over the place. And it's paying a 16% dividend. And you can see how it fell sharply in May and June, and now it's trending up. Now, I don't expect the stock to just go up to $11 over the next couple months, but it seems to be basing out here, and then I expect it will start a new bull market. And the stock could be $20 in 2 or 3 years. Who knows? G&T, this is a gold and income trust that pays a 10% dividend, and it's not really that volatile. And this is a position that, it can just sit there and I can get a 10% dividend, and that's wonderful, compared to, putting your money in money markets or bonds or whatever this day and age. However, I think that gold stocks and gold and oil and commodities are going to be booming next year. So I think this thing can be $20 in 2 or 3 years. It can fall down to $13 over the next couple months, but maybe it won't. Maybe it'll just sit at 15, or maybe it'll just start breaking out. I don't know exactly what's going to happen. All I know is that we're in a transition phase right now in gold stocks and world markets from bear to bull. If you remember last year in November, I said gold stocks are terrible and they're going to keep declining for a while. And I said the world is in a bear market, but most people in the United States don't even know it because they're watching the Dow and the NASDAQ, and they don't know. But now I'm telling you that bear market, it's different now. We're in a transition from bear to bull all over the world, and most people don't know that. But that's what I want to take advantage of, because over the next couple of years, that's where the gains are going to be. So I bought Newmont, gold stock. Here's the thing about gold stocks. Newmont's paying a nice 3% dividend. Now, you look at that chart, you can see it had an awful drop from $70 to under $45, and now it's going sideways. It could drop farther, it could go to 40, but it could pop up to 50, and then base and just boom, go into a giant bull market next year. But here's the thing about Newmont and a lot of these stocks in global markets. Newmont's super cheap on a fundamental basis. It's got a PEG ratio of 0.15, all right? A fully valued PEG ratio is a 1. That's how cheap this stock is. I think Newmont's going to be a $100 stock in the next couple of years. Newmont's got a forward P of 9, okay? It's so cheap, and it was cheap. If you remember, back in May, I took a stab at buying a bunch of gold stocks, and then they fell lower, and I got stopped out. I think I bought here, and then I got stopped out there, and I was saying they're super cheap. Well, look what happened when I got stopped out of Newmont. It fell down to here. It wasn't that big of a drop, then it bounced back up. So it's the same situation. If Newmont goes lower after I buy it, it's so cheap that I don't really think, cheap on a fundamental basis, that I don't really think there's much downside to it, and it could easily be up here before you know it. RSX, Russia, a PE of 6. All right, the S&P 500 has like a P of 15. This is a Russia ETF paying a 2.24% dividend, and I think this is a market that's going to go on a tear over the next couple of years. What could happen here is, it could, let's say everything just crashes and drops 10-20%. Well, next thing you know, Russia's down here. I've got a 10% now position in Russia, so I lose 1%. It's not a big deal, and I'm willing just to hold and weather that if that were to happen. But this thing could be up to $30, $32 before you know it in the next couple months, then pull back to 28 and then take off. Turkey, this is right now one of the most bullish stock markets in the world. Turkey broke out last week out of a stage 1 base, and I think it could be $100, all right, in a couple years, and it's paying a 2% dividend. It's got a P of 8. In other words, the valuation of Turkey is about half that of the S&P 500. I'm more interested in investing right now with new money in Turkey than buying the S&P 500. FTE. This is actually one of the neatest things I bought. This is the biggest telecommunications company in France. Think cell phones, think cable, all that kind of business. It's paying a 12% dividend. It's basing here. This is a stock poised to break out of its 200-day moving. It's above the 150. Poised to break out of the 200-day moving average and be at 15, just like you know it. The thing is, it's paying this giant dividend. So if it doesn't go anywhere, I'm making 12% over a year. If it breaks out and goes into a new bull market, though, that's a stock that's $17 in a year. 2 years, it could be 25, 30. Now, here's a different position. AI. Okay, this is an American mortgage company paying a 15% dividend. This is a chart from 2010 to 2012. And what I looked at when I was doing my research over the weekend, there's about a dozen American mortgage companies that have charts pretty similar to this. What they've done is they've went up from 2009, and they peaked out last year, and they went into a big base this year, and they're in a position to break out of that base. But the thing is, they're all paying big dividends. So anyway, I'm going to pick up this stock, get that dividend. If it doesn't do anything, I'm happy. Right, 15%. And I don't think this stock's going to break out and go crazy next year or whatever. But it could sit here, or who knows? It could break out and go up to $30. At some point, it probably will. It could be in 2 or 3 years. I don't know. But it's a nice little position I got in my account, paying a nice dividend, and that's neat. That's what I'm trying to do right now. Is my priority is to average in and get a core position of dividend-paying stocks, all right, and then build around that as the months go on with other positions that may be more momentum-driven. They may not be paying these big dividends. The truth is, I look through all the high dividend-paying stocks, and you can only buy so many of them because there's only so many out there. It's rare to find stocks paying these good dividends that got the good fundamentals, but here's a bunch of them. And I'm willing to put my money in that and invest in that for at least a couple years and try to benefit from that. And what about the U.S. stock market? You heard me put down the S&P 500 compared to these other ones. Well, I don't think the S&P is going into a bear market or anything like that. But the thing is, the upside potential for the U.S. market is a lot less than these global markets because the U.S. market isn't coming out of a bear market. It never went in one in the past year or two. And it's more highly valued on a fundamental basis as a result. It can trade in a similar pattern to everything else. Let's say it did go up here for a month. The S&P 500 could go up to 1425 or something, the highs of this year, then pull back in the fall, and then break out. Well, these are smaller percentage moves compared to these other markets I'm talking about. So there's more potential gains to be had elsewhere. But that doesn't mean you should sell the S&P if you're in it or in U.S. stocks. It's just right now, these other markets are in better positions. That doesn't mean there aren't going to be sectors in the U.S. that are going to do well. There probably are. I'm going to keep looking for them. But the big picture is these other markets can do better. I think you can see some fantastic things in gold stocks and commodities. But anyway, these are the positions I bought. Now let's look at the actual trades. Here they are. I bought about $20,000 in eight positions. I sold this SDS thing. Here are the transactions, so you can see them and look at them if you want to. See, I bought 2,000 shares twice of SDS last week, sold the 4,000 today. It actually got the commissions I'm paying listed down here. I'd factored in the commission and the average price there, so I didn't do it on that first initial buy. But these are the commissions I'm paying, and the price, and the number of shares, and the symbols if you want to keep track of that or do your own research and take a look. But basically, I've spent about $20,000 on average a piece each position, $160,000 worth overall. Like I said, I plan on putting more money into this portfolio at some point in the next couple of months and buying a lot more. But I'm just starting, and it's going to be fun as time goes on. And I think we can do this together. And I think the next couple of years are really going to be exciting. I was hoping we would see a big correction in September, have it start in August, but with what the market did last week, the odds of that happening have diminished. If it does happen, great. I'll deploy more money at cheaper prices. If it doesn't happen, though, then all this stuff can bounce up. Some positions will bounce up more than others, and I don't want to potentially miss out on some of these stocks here. So that's what I'm doing, and be buying more later and talking to you a lot more as time goes on. So if you got questions, just leave your comments below this video here and have a little discussion about them. So signing off and talking to you later on.